Charting Your Way to Wealth, Chapter 9, Trend Lines. The trend is your friend. Never forget this old stock trading adage. With stock charting, the trend is our best friend. Why? Well, that's because we are trend followers. We carefully wait for a trend up or down to emerge from the movement in price as seen on our indicators. When we locate a trend, we follow it. A new trend begins when the price percent oscillator crosses over the signal line on our weekly chart. We call this a weekly vertical crossover. And we begin looking for an opportunity at that point when these weekly vertical crossovers occur to start drawing trend lines and following price movement. Now, beginning chart readers are sometimes confused when they attempt to draw trend lines. Here's the rule: bottom up, top down. If the price is going up, you draw from the bottom. If the price is going down, you draw from the top. It is just that simple. Now, the goal is to attempt to connect 3 or more candle tops or bottoms in order to have an acceptable trend line. The more candles that you are able to connect, the more reliable the trend itself will be. Solid trend lines give us more confidence to stay in trades. Now, trends start to fail when candles penetrate the trend line. You will see that happen on your charts. When price movement goes flat, or even in the opposite direction, the trend may be failing. There is, however, another alternative. Price can and sometimes does back up. That is, it may go down and slide sideways for a while. What you need to look at is what is happening with your indicators. We call this digestion. It means the market is digesting gains or losses before continuing in the same direction. When this digestion is occurring, the indicators can be expected to continue pointing in the prior direction. That is, no crossover in the opposite direction occurs. Even though the candlesticks may penetrate the trend line and even go from green to red or red to green, if the indicators rotate in the opposite direction, you're not dealing with the backup. You're not dealing with digestion. You're actually dealing with a crossover going in the opposite direction. Now, when a trend line is violated and the indicators are rolling over, we should consider getting out of a trade, particularly if the price percent oscillator, that is our main indicator that we pay the most attention to, the blue and the red lines. If we see the price percent oscillator rotating over, then of course we're looking to get out of that. That is changing. Solid and sustained trend lines give us more security that the price percent oscillator and the derivative oscillator are giving us accurate signals as to future price movement. Failing trend lines can be an early warning signal that a market change is underway. Now, if I had nothing but trend lines, if that's all I had, trend lines and candlesticks, that could be enough to help me trade and have confidence getting into and out of the market. Always attempt to establish reliable trend lines. It's much easier to do with the Heikin-Ashi candlesticks that we use on our charts if you have a real trend. When you cannot establish a trend line and that trend fails, then of course always be watching the indicators in the time frames on your charts. Remember, you can use trend lines on all of your charts. The weekly, that is the long-term chart, the 2-day, that is our medium-term chart, and the short-term chart or half-day chart. If you have no technical assistance other than price movement, you should be able to trade with nothing more than trend lines. My friends, we always appreciate you being with us. Thank you so much. God bless, and keep the faith. Keep working hard.